All right, hi everyone. Welcome to today's webinar brought to you by IC Markets Global, where today's topic is going to be how to trade gold. All right, great to see the comments coming in. All right, hi HMH, hi James, Akokema, good to see you. All right, okay. Thank you everyone for tuning in today. I just want to make sure you can hear me loud and clear and see my screen as well. Where you should be looking at my screen, IC Markets Global webinar, how to trade gold, 27th of February. All right, if everything's good on the audio and visuals aspects, then we can let's kick things off. All right, thanks HMH. All right, thank you once again for everyone tuning in today. And just making sure everything good. All right, okay. Sure, okay, so before we start, as usual, let's go through the disclaimer. All right, this is marketing communication. It does not contain and should not be construed as containing investment advice or an investment recommendation or an offer of or solicitation for the transactions in financial instruments. Also, take note of the risk warning that comes with trading forex and CFDs. They carry a high level of risk to your capital, and you should only trade with money you can afford to lose. Right. So my name is Ketan Rameshchandra. So this webinar series is brought to you in a special partnership between IC Markets and Everest Fortune Groups, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. All right, okay, so here's the agenda for today. right? We'll start off. It's going to be a little bit of background knowledge and fundamental knowledge, and then we'll dive into technical analysis as well, and try and come up, try and see how we can come up and identify high probability setups as well. Right, just monitoring the questions coming in. All right, okay, just a couple of few channels I got to check. All right, okay, so we'll just look at uh, the fundamentals of gold first, like at the basic level. Right, we'll look at what the demand and production. We'll look at we've also hear a lot of um, statements about gold being a good hedge against inflation and crisis. So let's see if that's really the case. Then we'll also look at what is the relationship between gold and US dollars. The US dollar. This is something that we are all more familiar with, and perhaps we are also going to look at what is the relationship between gold and real yields as well. So what are real yields? We'll come to that at this in this section, and then we'll look. Then we'll dive into trading view charts and look at some examples of potential swing trades and how can we identify such setups. All right, hi Ryan, good to see you as well. All right, okay, so when we look at demand, right, gold is used in many industries and sectors, right? So this is based on the data by Statista. So in 2022, once again, jewelry is always the highest sector or industry for gold demand, right? Making up almost, this is in tons, right? Not in percentages, in tons, so almost 2,000 tons or more than 2,000 tons, followed by investments. So this is in terms of trading gold futures and any other financial instruments that are related to gold. And then you have central bank buying as well, a lot of buying by central banks. So when central banks buy gold, they're actually buying physical gold, right? And also investment here also would relate to physical gold as well by retail consumers, retail traders, and as well as institutional asset managers as well. And then of course it is also used in technology. For example, in printed circuit boards, the gold is melted down and used as PCB tracing on printed circuit boards and so on and so forth, right? Okay, so these are uh, the main sectors that see demand for gold, with jewelry being the highest, biggest sector, followed by investment and central banks, and then technology. Right. Then what about gold consumption? Right. I tried to find something more up to date, but I couldn't find anything that was more recent in terms of 2022 or 2023. But if you look at 2021 gold consumption, you can see, as expected, China and India have the largest volume of gold consumption in terms of tons. Right. You can see it's almost, what is this? Sorry, it is almost, okay. The right hand side axis is showing the axis for the gold consumption, which is measured in tons. So that's almost 900 tons, and India is about 850, 870, and then you can see the rest of the world has a much lower consumption. So the main drivers for gold demand are coming from China and India, and of course you can look at the website here as well, right? I've put in the links as well. Let me see if I can copy it. Okay, I'll copy it later, perhaps towards the end of the webinar. I'll copy it and paste it into the live chat box. Right, so no surprises there as to the largest consumers of gold. And moving into 2023 and 2024, uh, these these two or this level of consumption is not expected to have changed drastically. Okay, then next looking at gold demand through the years, right? So when we see this chart, it's showing us gold demand from to 2010 all the way to 2023, and it also gives us the total demand of gold globally, as well as breaking it down into the various sectors that I had mentioned earlier, right? Jewelry fabrication, technology, ETFs and similar products. This is investments, total bar and coin. This is physical gold, and then central bank net purchases. Right, central banks also sell gold, so they're giving it as a net purchase. Yeah, right. So as you can see, in 2020, gold demand dropped globally, but then it started to pick up quite steadily in 2021 and 2022. 2022 was probably one of the highest periods of gold demand, right? As you can see, it was clearly higher than it was a almost a 9-year high, right? The highest level was back in 2013, and then 2022 marked the highest level since then, since 2013, so 9 years ago. Oh well, now 10 years ago, yeah. And then in 2023, gold demand has dipped a little bit, right? Dipped about 5%. So this just tells us the trend in gold on an annualized basis from a global perspective, and also when you break it down into the main sectors, which is once again jewelry fabrication, which usually makes up the bulk of the demand, technology, total buy and coin, which is physical gold, ETFs that is bought by retail traders, um, institutional asset managers, and so on and so forth by anyone, then ETFs and similar products, which are investment related uh, purchases, and then of course central bank debt purchases as well. All right, then when we look at gold production, who are the biggest producers of gold globally? Well, it's no surprise that China is also is the biggest producer of gold, producing about 330 tons annually. Then we have Australia in second place, producing 310 tons. Russia also 310. Canada 200 and United States 170. All right, hi Duran. Yes, I'll copy and paste the links towards the end into the live chat box towards the end of the webinar. All right, yeah, just let me go through the webinar and then I'll do it right towards the end. All right, that's okay. Let me see any other questions, comments coming in. Nope. All right. Okay, so this is just a brief overview of demand and production for gold, just a little bit of fundamentals to understand who are the biggest consumers, who are the biggest producers, where is actually gold going into, which industries is it sought after, and just to get some general knowledge as well on this commodity. All right, next we will dive into the topic of uh, gold as a hedge against inflation and crisis, right? We always hear statements that gold is a great hedge against inflation, it's a great hedge against crisis. Is this really the case? Does it always uh, function as a good hedge in periods of high inflation or going into crisis, right? So let's just see how gold has really performed through such situations, right? All right, so when we look at gold and inflation, so we're going to compare the prices of gold futures with the CPI in the US. So CPI is Consumer Price Index. It measures the level of consumer inflation, and this is on an annualized basis. So gold prices are in is charted in orange here, and the axis is on the right, and CPI data on an annualized basis, right, year over year here is plotted on the left. So as you can see, in the late 70s was another period of high inflation, right? The early 70s to late 70s was a period of high inflation as well. So when you saw the second inflation wave rise come in into the US in the late 1970s, you can see gold prices rising strongly as well, going from about okay, I don't have the exact scale here because it's probably 300, probably going about $200 per ounce to as high as about $650 per ounce, right? So you can see in this period in the late 70s, gold did function as a good hedge against inflation. We can see inflation rising very rapidly, gold rising rapidly as well. And then as inflation peaked and started to slow down, right, the rate of change started to decrease. We also saw gold prices pull back as well. So in this period, yes, we saw gold uh, actually functioning as a good hedge against inflation. Now, the next inflation pickup comes in mid 1980s, and we can see inflation CPI going from about 2.1 2.2% rising quite sharply to about nearly 5%. But over this period, we see that gold did not actually function as a good hedge. Then moving on into the 1986 and 87 periods, we see inflation once again rising strongly, and during 1986-87, we can see gold prices rising as well. So in this period here, in the initial part of the 1986-87, or rather over these two periods, over these 2 years, gold did function as a good hedge against inflation. But as inflation continued to increase from 1988 all the way to 1990, actually gold started to pull back and head lower, right? So we can see already in three instances where gold does not necessarily always function as a good hedge against inflation. It can, but that's not always the case. So we'll look a little bit later into why that happens. Similarly here, in 1999 to 2000, we can see inflation rising rapidly once again, right, going from about 2% year over year to almost 4%. But over this period, gold actually just traded sideways and, in fact, was starting to go lower. So, in this period, gold did not function as a good hedge against rising inflation. But where we see gold functioning as a good rising as a hedge was in 2003 to 2006. So over a period of 3 years, as inflation started to pick up, we also saw gold prices pick up as well. But this also coincided with the commodity boom. There was a big commodity boom in the early 2000s, which lasted all the way till 2007, before the Lehman Brothers crisis, and we saw gold prices pull back together with other asset prices as well. Right, so during this period here, from 2003 to 2007, it was also a strong commodity bull cycle, which saw gold prices as well as other commodity prices, of course, rise very strongly over this period. And then, then we saw gold prices continuing to rise throughout 2010 all the way to about 2011, right, peaking as high as about, I think this was about $1,800 per ounce. And then after that, it went lower. And then coming to the latest inflationary environment, right, which is 2021, 2022, and 2023, right, we can see CPI inflation picking up at the end of 2021 quite rapidly and rising very strongly in 2022. So during this period here, right, we can see gold did function as a good hedge against inflation in the initial part of rising inflation. But as inflation continued to rise higher in 2022, peaking at about 9% year over year, gold actually started to trade sideways, right? It didn't continue uh, get going higher. So you can see that in the initial phase of this period of the high inflationary period, gold did function as a good hedge against inflation. But as inflation continued to rise higher, gold prices sort of stalled and traded sideways. Roughly speaking, right? So you can see, yes, there are periods where gold will indeed serve as a good hedge against inflation, but there are also instances where it will not, right? So that's also down to the market environment and the macro environment. So this is just to let us give you some background information that throughout history, or at least since 1976, gold has functioned as a good hedge against inflation, but it's not always been the case, right? There's been instances where gold will not function as a good hedge against inflation. So just want to let you guys give you a quick background on that. Right. And gold versus US recessions as well. We also hear about gold serving as a good hedge when the US goes into recessions. So if you can see here, the gray shaded bars highlight the periods of recessions in the US. So 1973, 1980, 1981, 1990, so on and so forth. The blue line is the S&P 500 index. So just try and ignore that while we focus on gold prices. So as you can see, in 1973, during the recession, gold prices rose, coming as high as almost $200 an ounce. So in this period here, on rather during this recession, the 1973 recession, gold prices actually performed well and was a good hedge against the US recession, with gold gaining 87%. Now, in the 1980 recession, you can see gold did not function as a good hedge against the recession. It actually rose very strongly before the recession, and as recession started, it actually lost 5.1%. Similarly, in the 1981 recession, you can see once again gold prices actually were dropping lower, and as the recession ended, that's when gold prices actually started to pick up. So if you look across here, you can see that once again, uh, buying gold blindly ahead of a potential recession is not a sure guarantee that you can hedge well against it, right? There can be periods where you will benefit from it, and there are periods that where you may not, right? So how can we identify that? Well, we'll have to look at. I'll try and explain that in the slides later on. So in general, gold will can function as a good hedge against recessions in the U.S., but take note, is not going to function well in every recession, right? Now, this chart here just zooms in into the um, comparison between gold futures and recessionary periods, right? We had in 19 this was 93, but in 1980, 1983, right? So 1980, 1981, 1990, and so on and so forth. So when we look at these charts here, you can see, right, in the first recession in 1980 here, gold did serve as a good hedge as the recession started, but it then pulled back. And then in the second recession in 1981, it did not function as a goal, did not function as a good hedge. It actually continued to drop lower, and it actually started to increase only as the recession was ending. Then in 1990, 1991, it sort of just went sideways. You know, it didn't really do anything. Even in 2000, when we had a major recession, gold didn't really do anything either. It was pretty much flat. And even here during the Lehman crisis, gold prices were actually going higher. As I mentioned, this was primarily due to the super bull cycle in the commodity space, which caused this sharp rise in gold prices as well as other precious metals and agriculture as well. And then actually going into the recession, as recession started, gold prices actually started to pull back and only started to increase strongly as the second half of the recession played out, right? And here also you can see gold prices actually pulling back during the actual recession. So gold can function as a good hedge against inflation, against recession, but it's not certainty, right? So that's the message I guess I'm trying to put across here. All right, okay, now we'll look at the relationship between gold prices and the US dollar and real yields. I think we are all pretty familiar with the relationship with the US dollar, right? So we all pretty much know gold prices and the US dollar have a negative relationship, right? So it's a negative correlation. So that means as the value of the dollar is rising. So in this case, we're measuring the value of the dollar by looking at the dollar index. So when the dollar index is rising, that means that the US dollar is gaining is strengthening or gaining versus its peers. And usually that means gold prices are going to be depressed as well. Usually, right? Typically, that's what it means. Right. So as in 2022, uh, we can see that, and also here even in 2020, as the value of the dollar index was falling, right, we can see gold prices rising quite sharply. So we can quite clearly see the inverse correlation between the value of the US dollar and gold prices, right? So here you can see periods. Okay, these vertical lines, I just marked them to indicate where the dollar index has experienced temporary resistance level or a swing, right, or a pullback. Yeah, so a top, basically a temporary top. So when that happens here and prices pull back in the dollar index, you can see gold retracing a little higher. But then dollar index starts to rise again, gold prices fall. Dollar index pulls back, gold retraces higher, but then dollar index goes on to go make a new high and gold prices drop. But over here, you can see in September, October of 2022, the dollar index peaks at this level here. I think it's about 115 if I'm not mistaken, and then starts to drop sharply. And during this period, you can see gold prices starting to rise strongly as well. So I think it's quite clear that that the value of the dollar and gold prices have a strong negative correlation, and it's something that we should take note of as well when we are trading, right? So when we see the dollar is in a strong bullish trend or a strong bearish trend, that means it's quite likely we're going to see gold prices falling when dollar is high, and of course we are likely to see gold prices picking up when dollar is weak. So it's important to understand this negative correlation so that we can identify the current trend that we are in, and then help us identify suitable trade ideas or trade setups. Right. Then we also talked about the relationship with the U.S. government 10-year bond yield. So when you have an environment where the value of the U.S. dollar is rising and the U.S. 10-year bond yield is also rising, right, this puts great pressure on gold prices, because not only is the value of the dollar rising, but then because government bond yields are rising as well, uh, they will investors are likely to buy bonds as well as a better hedge against inflation as well. Okay, then we'll look at what are real yields. We also talked about the relationship between gold prices and real yields. So just to simply explain what is the difference between nominal yields and real yields. So government yields are quoted in nominal terms. So that means like what we see here, the US 10-year bond yield, right? It went as high as about 4.2% in the middle of 2022, and of course it dropped lower since then. So this is what we see here, right? This figure here, this bond yield here is in nominal terms, right? That means it has not been adjusted for inflation, right? So when you see government bond yields, they are quoted in nominal terms, like what we saw in the previous slide, and these are bond yields that are not, they're called nominal because they're not adjusted for inflation. So when you have real yields, they're calculated by taking real yields are calculated by taking normal bond yield minus the expected inflation rate. So this is what it means by real yield. So there's a strong relationship. There's also a strong inverse relationship between gold prices and real yields. So if we head on over to this website here, long-term trends, right? On this chart, the line in yellow is the price for gold in ounces, right? So $500 per ounce, $2,000 per ounce. And the black line is showing us the inverted real yield, because gold prices and real yields have inverse correlation, just like the gold prices and the value of the US dollar. But because they have an inverse relationship, on this chart, they have printed it, they have illustrated the real yield as an inverted figure to explain to us the tightness of the relationship here. So as you can see, as real yields are becoming less negative, take note, real yields, the axis is on the right. So the lower part is 2.4%, the higher part is negative 2.4% because it's inverted. But as you can see here, it's inverted to show us that they tend to move together. So when real yields are rising, or real yields are becoming less positive, from going from 2.4% to about 0.8%, gold prices are rising. Hi, James. Sorry, I won't be covering Bitcoin in relationship to gold prices here today. We're just going to be focusing clearly on uh, gold and the dollar and real yields. There's no, from what I see, there's no real relationship or true fundamental relationship between Bitcoin and gold prices. So yeah, I'm not going to be, unfortunately, I won't be touching on that today because we don't have time for that as well. All right, apologies for that if I can't go into details for that. All right, okay. So this chart here explains to us the tightness in the relationship. So as real bond yields go from more positive to less positive and even into negative territory, this usually tells us that gold prices are going to rise, right? So you can see the trend is for real yields to go from more positive to less positive to even negative. So that in this environment, gold prices are likely to follow suit and go higher as well. Similarly, when real yields become more positive, right, they go from less negative to more positive, gold prices tend to pull back. So you can see this relationship play out quite well. But it does seem in recent years, in the last 2 years, this relationship has been broken, right? It looks to be somewhat broken. So let's zoom in a little bit here. So as you can see, despite real yields becoming more positive, this should have actually caused gold prices to pull back more than expected, but it didn't, right? Right. Okay. So and then so we can see there's a little bit of disconnect between the relationship between the inverted real yield and gold prices here. So in general, if you want, you can look at this website here and see that this relationship has played out quite tightly over the years, but over the last 18 months or so, it seems to have somewhat broken down a little bit. But it might be important to revisit this should should this relationship tightens up again, because no correlation or negative correlation is always 100%, right? Correlations and negative correlations exist. They are never 100%. It could be 80%, 90%, and at times as well they can break down over certain periods, through certain periods. All right, okay. Now, all right, if there are no questions, then okay, wait, first of all, are there any questions with what we've covered so far? If not, then we'll head on to the charts on TradingView, and then we'll try and see some examples of how we can identify uh, suitable swing setups. All right, okay, if not, then let's just dive into the charts on TradingView. All right. Okay, so on this chart here, I am on the daily time frame. Right, okay, so I'm on the daily time frame here. So I've got a few indicators up here. I've got the Ichimoku cloud in the background here, right? Red, bearish Ichimoku cloud, green, bullish Ichimoku cloud. I've also got the stochastic oscillator. I'm using the parameters 23.3. And also I have the RSI indicator as well with the moving average of the RSI plotted over it as well. All right, so gold is currently trading about $2,000, $37 per ounce, right? So as we know, you typically, right, when okay, I'll just quick. Is everyone familiar with the Ichimoku cloud? Okay, just a quick review. All right. Okay. All right. Thanks so much, Skipper. We'll take note of that. Charts could be big. All right. Let me try and make the indicators a little bit smaller, and perhaps I try and um, yeah, perhaps is this better? Right. I'm making the windows for the indicators a little bit smaller and the chart itself a little bit bigger. I hope that helps. All right. All right. Thank you for the feedback on the picture quality. We'll definitely take keep that in mind and see how we can improve the resolution. All right. Okay. So for Ichimoku cloud, basically when the cloud is green in color and price is trading above the Ichimoku cloud, it indicates a strong bullish momentum, right? It's a momentum indicator. So when the cloud is green in color and price is trading above it, it tends to indicate a strong bullish momentum for price. All right, okay. And then usually the or not usually but typically the bullish Ichimoku cloud can act or function as areas of support. So should we see price pull back into the cloud, right, the cloud can offer a strong area of support. So it also helps us to identify major a potential support zone for gold prices or any other instrument that we may use for Ichimoku cloud. Similarly, when the cloud transitions from green to red, it means that the bullish momentum has ended and we are in the beginning of a strong bearish momentum. But you can also see that here, price has crossed through the bullish Ichimoku cloud as well. So when price crosses through a bullish Ichimoku cloud, we can also conclude that the bullish momentum has ended and the trend is likely to be to the lower side. And when the cloud turns red and price is trading underneath it, the cloud can also function as a major area of resistance. So we can see price rising quite closely to the cloud several times, or even perhaps going into the cloud, as we see here on August of 2022. The bearish Ichimoku cloud can also function as a major area of resistance and also helps us to give a good indication here, right? So do take note when prices cross under a green or bullish Ichimoku cloud, the bullish momentum has very likely ended. And when price crosses above a bearish Ichimoku cloud, it means that the bearish momentum or the bearish channel has ended and we are start on a very likely to start a new bullish move up. So when we look at the Ichimoku cloud and we look at the stochastic oscillator, right? As we know, stochastic oscillator usually, when the reading goes above 80, it typically highlights potential overbought conditions. Similarly, when the reading goes under 20, it typically highlights oversold conditions, right? Similarly, we have RSI as well, which tells us the relative strength of the instrument itself, right? So we are trying to combine the three indicators here, bullish Ichimoku cloud, stochastic oscillator, and the RSI moving average to help us identify potential swing trades, whether they're swing high uh, trades, meaning bearish reversal trades, or bullish reversals. All right. Okay, so let's just use 2023 as an example, right? All right. Okay, let's just look at. Okay, we'll zoom in a little bit here, and we'll start from the end of. Let's just start from 2022. Right. So when we have usually, so okay, let's start out with looking at potential bullish reversals, right? So I'll just highlight the bullish reversals as well. So typically, when we see Um, right. So typically, when we see periods like this, when the stochastic oscillator and RSI indicate very strong oversold conditions, right, we should be looking at potentially identifying a potential bullish reversal here, right? So as the stochastic oscillator comes back up towards 20, we also see this RSI coming back up towards this threshold, which is 40 again, right? In this period here, right, typically signals a potential bullish reversal, right? Because you can see here, sometimes it's a little bit better to be patient, right? A little bit better to be patient because if we had tried to buy the dip here, as soon as stochastic oscillator went under 20, RSI dropping under 40 here, right? We would have been a little bit early on the bullish reversal here. Of course, the price did retrace a little bit higher, but it wasn't a strong move. But as you see, as the stochastic oscillator and the RSI start to both head up and start to cross over again. This is the period here where it would have been, it highlighted or it signaled a high probability of a potential bullish reversal here. So gold prices went from what's 1,767 to as high as 1,830, right? And as the oscillator, stochastic oscillator climbs above 80, it also tells us a potential, it also helps us to identify a potential moment to start considering taking profits on the long gold trade, right? So that's how we're going to use the combination of RSI and the stochastic oscillator. Right, so we can see here as the oscillator moves up, this is in July of 2021. RSI also is moving higher away from the oversold conditions, and we also see price rising quite strongly as well. Right, similarly, then over here, oops, sorry. Right, this is another period here where we see, okay, although the stochastic oscillator doesn't drop below 20, but it comes very close to this level, but we do see RSI dropping quite low, going as low as 25. Right. Yeah, that's right, James. Yeah, you can also use this, use the stochastic oscillator, RSI, and Bollinger Bands as well. Right. I'm just using stochastic oscillator and RSI, but of course you can use them and combine it with any other indicators that you're familiar with. Right. Bollinger Bands work well as well, or any other indicator that you may have. Right. So this is not uh, analysis that is set in stone, right? Of course, we can fine tune the analysis, we can fine tune the parameters as well, and overlay it with other indicators to find and highlight the best or to to identify high probability setups, right? So over here, although stochastic did not go under 20, but we do see the RSI dropping quite low here, going as low as 22. And then as it starts to turn up together with the oscillator again, and we also see this wick here, this long wick here, all these point to a general all these point to a typical bullish reversal. So similarly, we can see even if we didn't catch it right at the bottom over here, but by this point, even if from here, from about 17,740, we would have still made a pretty decent gain with prices breaking above 1,800, going as high as 1,830. Similarly, as you can see with stochastic coming up to as high as 95. Once again, it highlighted a potential top in price action, right? Which highlighted a potential top in price action. So during this period here, going long here in August of 2021 and exiting around early September of 2021 would have uh, netted us a pretty decent, or would have netted us a profitable long trade as well on the bullish reversal here, right? And then, as I mentioned, the Ichimoku cloud can function as resistance as well. So with price coming into the bearish Ichimoku cloud, we will also tells us that price is quite likely to stall within the bearish Ichimoku cloud as well. And then when price reverses here, and we can see stochastics turning lower with price trading in the bearish Ichimoku cloud, this price action and indicators as well help us to identify a potential short entry as well. right? It helps us to identify a potential short entry, and you can see here gold going from 1,816 to as low as 1,720. All right. Okay. Thanks, James. Thank you very much for the kind words. So as price comes down here, similarly, we can see there's a couple of instances like, okay, here 17th September 2021, this could have been a potential fall signal here because we see price only rising for about 2.5 days before making another leg lower. Price only retraced a little bit higher. So in this case, on 17th September, this analysis would have probably given us a false signal. So this also shows us that no analysis is always 100%, right? But what we're looking for is analysis is going to be giving us a much better probability of successful trades. So similarly here, so we can all conclude quite convincingly, right? We can convince ourselves that 17th September 2021, 18th September 2021, right? The setup did not yield a very profitable trade. Yes, we did see prices go higher, but it was not a sustained move. Where we do see a sustained move was on 30th September onwards, right? So we see both um, oscillator and sorry, RSI and oscillator uh, indicating oversold positions, and as they rise up and climb above 20 here and climb above 40, we can also see generally price making a strong bullish move up as well. Of course, it was a pretty over here was a pretty not choppy, but there were pullbacks along the way. But generally, you could see that the trend was to the upside here, right? Similarly, uh, over here, we can also use, as we see RSI here coming up as high as, what is this, 73, stochastic also indicating overbought conditions. And at the same time, we see price not breaking above this like resistance here at 1,868, right? So we can see also price forming a nice top here. And as the RSI oscillator starts to turn lower, the stochastic oscillator also starts to turn lower. This also helps us then to identify a potential short entry as well, right? So because we have both the RSI and stochastic oscillator indicating a high probability of overbought conditions, and we also see price failing to break above this zone here, right? This is a pretty strong resistance zone for gold during this period, right? So this highlights to us price action as well. We can see price clearly topping here over a few days, and as it starts to drop lower, we can help. It helps us to identify a potential short entry as well, right? So we have here another short entry. Now this part here during this period, it gets a little bit more trickier, right? You can see that we didn't get any very clear uh, signals for a bullish reversal, right? Price actually traded sideways between 1,700 and about roughly 60 and 1,790 over a period of, let's see, 30th November till 15th December. So for a period of 2 weeks, price was just consolidating here before finally moving higher, right? So this part here would have been a bit more trickier to identify a potential bullish reversal here. But as stochastic finally started to rise above 20, and we also see the RSI rising as well, then this would have helped us to identify a potential long entry as well. Because if we look here, we can also see that this is a pretty decent support level, right? Price finding support at 1,760, right? We managed to consolidate over here, and then as price bounced off this level one last time, and with stochastic moving up, RSI moving up, it does give us a good indication for another bullish move to the upside. Even here, of course, the prices were pulling back along the way, but we can then use the combination of the stochastic oscillator as well as the RSI to help us identify a potential exit point for the long trade as well. Similarly, for the short trade, as prices are coming down, right, we will be using the oscillator as well as the RSI to identify a potential exit. And also what I would also use is a previous support level, right? So we see here back on 33rd of November 2021, right? This was a pullback support level that just identified it as a first support. So we can see price making a pretty significant swing bounce off this level as well. And as price is coming down, I would also use this level here as a suitable take profit for any short trades as well, right? So we can also use previous support levels to help us identify uh, a suitable take profit for the short trading, for the short side. All right, then we can also see here as well on 31st of Jan, right? So I'm just going to move this up here, right? We can see price finding first support here on 7th of Jan, moving higher and dropping down here on 28th of Jan. So we can see here price has formed a double bottom. We also see the oscillator hinting at oversold conditions. We also see the RSI dropping quite low here at about 40. And then as price bounces off 1782, we also see the stochastic oscillator moving up, RSI moving up. Once again, this gives us a good entry, a good signal to help us identify a strong move up. So from here, we can say even if we took it at the top of the cloud here at about 1810, we can see that even if we exited at when in November, where stochastic showed oversold conditions, right? At least we would have captured a pretty decent gain with prices going as high as 1913, right? So of course, it's in this case we had a very strong uh, bullish move in gold prices, right? So even if we had just strictly followed the oscillator, we would have actually exited the trade earlier. But as I said, no analysis is 100% uh, accurate, right? We can, if anyone can catch the absolute bottoms and absolute tops, well, congrats to them. I mean, but yeah, generally speaking, right? If we can catch somewhere near the bottom and get an exit that is as close as possible to the top, that's fine, right? But here you can see this was a good exit point here as indicated by the oscillator, even here as well, and over here on 30th of September as well. So in most cases, when the stochastic oscillator climbs above 90 or close to 90 on a daily time frame, it does usually indicate a good time to exit any long positions. But of course, there can be periods like this in early 2022 where gold just went surging higher, breaking above $2,000 per ounce, climbing as high as 2070. Right. So here, um, so in this case here, with prices making a strong, uh, uh, making a pretty much, I think this was like an all-time high back then in 2022. Then prices started to pull back quite sharply. We also saw not only the stochastic oscillator but also the RSI indicating very overbought positions here. So as prices pull back sharply on 9th of March, we can probably identify a suitable short entry, right? Because we can see stochastic is definitely indicating overbought conditions. So is stochastic, and as they start to turn and move lower, both indicators start to turn and move lower. It does help us to identify a potential bearish reversal, and then we could have entered a potential trade here at about 1980, with prices dropping as low as 1895. All right, okay. So and here, during this period here, you can see from March onwards, prices actually sort of consolidated above this level here. So it took a while before prices sort of stabilized before trying to make a second move higher. But this time, but you can see on the daily time frame as well, price failing to break up below 1915, right? Price consolidating above this level since 15th of March till 7th of April. So for a period of about 3 weeks, right? 3 weeks price was consolidating above this level somewhat before making another move higher, but uh, this move wasn't as strong as what we saw in early 2022, but we could also see stochastic rising higher during this period with prices also trading above the bullish Ichimoku cloud. Remember, I also mentioned that the bullish Ichimoku cloud can function as areas of support. So as we see price bouncing off this price level at 1916, we also see the oscillator moving higher, prices continue to trade above the bullish Ichimoku cloud, it would have also helped us to identify a potential long entry at about, let's say, 1940, right? And as the stochastic oscillator came as high as 90.50 here, it would have been a good time to exit the trade as well. So probably going as high as 1990, right? So you can see here this time with stochastic oscillator climbing as high as about 91, it did help us to identify a suitable exit for the long trade here. Then, of course, remember I mentioned that when prices cross a bullish Ichimoku cloud, right? Usually the cloud can offer support, but when the cloud does not offer support and prices move through or cross below the bullish Ichimoku cloud, it usually tends to signal a major reversal in trend. And as you can see from 25th April of 2022 all the way till 4th of November 2022, so for a period of nearly 7 months, gold prices were in a strong downtrend, right? So uh, not only did the crossing of the bullish Ichimoku cloud help us to identify a major reversal in trend, we can also see that the cloud turned red, which indicates a strong bearish momentum. So it's in a situation like this, we should be looking to identify major resistances and then try to find resistances together with stochastics to help us identify potential short opportunities here. So let me just remove this. So over here, we can see that as price moved down, sorry, as price was falling from about 1950 to as low as 1790, right? Then it consolidated for a while. This period here, there were no real swing trades, right? There were no real swing trades to take advantage of. But as price came close to the Ichimoku cloud, right, the bearish Ichimoku cloud, I mentioned that it can function as major resistance zones. So as price comes close to the bearish Ichimoku cloud, this is also where we can expect prices to run into resistance once more. Then of course we can fine tune the analysis by moving into the lower time frames, right? Currently I'm doing everything on a daily time frame, but once we know price is reaching perhaps a major resistance area as indicated by the cloud, we can then switch into the 4-hour time frame, 1-hour time frame, or any other lower time frame that you're familiar with to help us to fine tune the analysis. So over here, of course, during in any bearish momentum or bullish momentum, there's bound to be retracements as well. So this over here, you can see price retracing quite strongly, but as it moved into the cloud, it ran into resistance. Not only did the cloud offer an area of resistance, but we also saw stochastic oscillator climbing as high as 95, indicating overbought conditions. We also see RSI climbing quite strongly, hitting 60 here, also pointing to a potential top in gold and gold prices here, right? So once again, we can see the combination of the Ichimoku cloud, the stochastic oscillator, as well as RSI, as well as the price action itself, highlighting a potential top in gold prices before reversing to drop lower. Then, as of course, as price moves away from 1,800, it starts to drop lower. We of course see stochastics turning lower. We also see RSI dropping lower as well, helping us to identify a potential short entry or a bearish reversal on gold prices here. Where would we identify a suitable take profit, right? As I mentioned, a previous support level here, right? Price making a pretty significant swing. Oops. Price making a pretty significant swing low bounce of 1,697 back in July of 2022 before going higher, right? So I would have used this support level here to identify a suitable take profit as prices were coming down. Right. And also we can also see that the support level, as price is approaching the support level, we can also see stochastic move into oversold conditions. We can also see the RSI indicator moving below, dropping quite low as well. All right. Okay. So as we come towards the last 10 minutes of this webinar, let's move on into so if you do this analysis on the daily time frame, right, we are able to identify high probability setups for reversals and for bearish reversals and bullish reversals, right? So let's try and do the analysis on where price is currently trading, and we can see where are the current opportunities, right? Okay, so let's end the session. Let's wrap up the session by performing the analysis in 2024 and see what are the current setups. All right. Okay, so right as we can see, uh, with price crossing the bearish Ichimoku cloud convincingly here in October of 2023, right? We can also see that this is highlighting a potential uh, change in trend. So we can expect prices to start on a strong bullish trend. Of course, we can see prices pull back a little bit before going higher, right? And it actually found support as well. So you can see this level here at 1942. This was previously a pullback resistance level, right? Price failed to break above this level here in September of 2023, as well as in the first week and third week of 2023 of September. Sorry, prices failed to break above this level. So this level was a previously functioning as a pullback resistance level, but as price broke up, this level could then potentially function as a support, which it did. Right, we can see, of course, price did fall a little bit below 1942, but you can see how this level here functioned as a pretty strong support before prices moved higher, right? So we can also use previous support resistances and support levels to help us identify that. So if price had continued to trend lower here or break lower, then this would have indicated naturally that or quite clearly that prices would continue to drop lower. But in this case, no, prices actually found support at a previous resistance level and moved higher. We can also see stochastic turning up, RSI as well. So this once again would have helped us identify a potential long entry for gold prices. Let's say hypothetically we entered at 1963 and we use the stop of the stochastics here, the overbought condition of the stochastic at this level here. So going from about 1965 to even as here about 2035, right, would have netted us a pretty decent return. Okay, so currently the most recent bounce was here for gold prices, right? We see price making finding strong support here, right? If you look here back in December of 2023, mid December, prices came down but bounced off 1975 quite strongly. And in middle of February this year, prices came quite close to this level before reversing to go higher. Right, so you can see price did not come all the way down to the swing low support of December 2023. It came quite close, but we can also see stochastic indicating a potential oversold condition. Similarly with stochastic as RSI as well. Right, so as price reverses above this major support level, and also we can see stochastic turning higher. This also would have signaled to us a potential reversal in price as well. So probably catching it at about 2002, with prices coming up here at about 2032. Still, it's not a very strong bullish move, but it still would have helped us identify a suitable or high probability long setup. And okay, so what I would highlight here, gold is actually sort of trading sideways, right? It's actually ranging between uh, approximately between 2088. I would probably highlight this as the second resistance here, and the first resistance would be this pullback level here, which is at 2054. Right, so you can see prices are ranging between uh, since mid of Jan, prices are ranging approximately between 1,990 and about 2,055. Right, approximately you can see gold prices have been ranging sideways since 1st of December 2023. We don't see any clear bullish move to the upside, nor do we see any bearish move to the downside. When you look at it on a daily time frame, you can see it does look to be in a range bound trading. So when you're in a situation like this, it's important to identify uh, the trend that we're in, whether it's been a strong bullish trend or bearish trend. We know how to set up our trades accordingly. And when it is actually in a range bound trading environment, it's important to highlight the support levels or the key support levels and key resistance levels so we can identify potential uh, levels to play off as well. So now, as we can see, price has run into resistance twice at 2054, once on 15th of Jan, the second time of 2nd of February. So should price come close to this level here, it may run into resistance once more. So if we have any long gold positions, right, if you've managed to catch this swing here, swing low here, and as price is rising higher, right, take note of the first first resistance at 2054. At least in this region of 2050 2054 is a place where we at least start to take some profits as well. So maybe if you want to hedge your position as well, you could probably close half of the position as price comes up close to this level, um, or you could even just close out the entire trade itself, right? So it just depends on your trading style. Should you wish to close out half of the trade and let the second half ride, or do you just wish to close everything out, right? So do take notes. And if price does reverse off the first resistance and starts to drop, right, it also helps us to identify a potential short entry. And then where would I target a potential take profit level for the short entry? It would be within this zone here, right? So anywhere between 1993 to 1975 would be a potential or a suitable take profit zone should prices reverse off the first resistance, right? And that's also if we continue to see the range bound action in gold continue to play out, right? It does seem like it's taking a little bit of a breather, right, over the last almost 3 months now, right? December, January, Feb, over the last 3 months, we're not seeing any strong bullish moves or bearish momentum. It does seem to, yes, there are strong moves up, short bursts up, and short moves down, but generally we can see it is in a sideways environment. So do take note of the key support and resistance levels. For now, playing off these levels is likely to yield uh, a good trading setups or high probability trading setups, right? So should prices reverse off the first resistance and start to drop lower, we can identify a suitable short entry with the stop loss probably just above the top of this wick here, right? You can see this wick here at 2065. So probably a suitable stop loss would be just slightly above the top of this wick. And then as prices are falling lower, should prices continue to fall lower after reversing of the first resistance, we can then target the zone of 1993, or is it 1992 and 1975 as a potential take profit for the short trade, right? All right. Okay. So we've come towards the end of today's webinar. All right. First of all, I'd like to thank all of you for joining me, and hope this has been a great session for all of you. And right, yeah. So if there's any questions, I can. We still have like a minute or two left, so I can probably go through a couple of questions. Should there be anything? Otherwise, thanks everyone for tuning in today. Do look out for all upcoming webinars by IC Markets, and I look forward to seeing all of you at the next webinar. All right, thank you everyone. Thank you for your time, and thanks for tuning in. And I wish you all the best in your trading journey. All right, take care, everyone. There's a question by Richard. All right, do you always trade daily TF? Well, for me, more yes, because I'm more of a swing trader, so I would use the daily time frame to help me identify uh, potential reversals for the bullish reversals as well as bearish reversals, and then I would fine tune the analysis by moving into the lower time frame, right? So from a daily time frame, you could go into the 4 or 1 hour time frame to identify or to fine tune the analysis, right? That's what I would say. All right, okay. So so that's it for today. Thanks everyone for tuning in, and I'll catch you guys at the next catch all of you at the next webinar. All right, thank you everyone.